Hey there, Investorholics. Welcome to the 36-month performance update on the CommSec Pocket app. The three best ETF investment portfolio. So those are the ones I chose 3.5–4 years ago now. Obviously, the market's down, so stick around and have a look how this little portfolio is performing. Hey there, Investorholics. This is Scott. KrackTheSky Value Investing will be giving you up-to-date investing news and content so that you can navigate the markets wherever you are. My mission here at KrackTheSky is to give you the knowledge and the confidence to take control of your personal finances, expand your investment horizons, and crack your financial sky. So don't be afraid to give me a thumbs up. And also subscribe. It helps get the message out there. It helps pump the algorithm for YouTube. Just in general, it sort of gives me a bit more motivation as well to keep doing these little reviews for you guys. Thanks. Okay, for those who don't know, just a quick recap of how the CommSec Pocket app works. So you got minimum investment amounts of $50 per trade, so you can do your micro trades and sort of start building up your investing from scratch, from a small base. So this is an interesting product to use anyway. Okay, so let's have a quick look at the 7 options you have to invest in the CommSec Pocket app. So you've got the BShares Global Sustainability Leaders ETF, the iShares MSCI Emerging Markets ETF, iShares Core S&P ASX 200 ETF, iShares Global 100 ETF, iShares Global Healthcare ETF, the SPDR MSCI Australia Select Harvest High Yield Fund, Select High Dividend Yield Fund, if I can get that right. And you've also got the NASDAQ 100 ETF, and that's from BetaShares. Okay, as most of you guys will know, we've had a pretty dismal year. Lots of talk of recession and all that type of jazz. So no surprise here that we're seeing lots of negatives. The only stocks that weren't negative, I suppose, were IOO, which was just above negative 0.66% return for the 12 months to October 31st through to October 31st, 22. SYI, that performed reasonably well in the context, I suppose, of 4.24%, and healthcare performed pretty well. IXJ would have returned 11.35% or thereabouts. So, with those type of numbers, that's going to, what's the word? Impact. Impact is the word. Impact our overall performance when we have a quick look at that. But, definitely opportunity to buy if you're in here and you own any of these. Quite possibly it's an opportunity to have a look at buying some more because you're not going to stay negative performance in the long run. So if you're buying, doing your reinvestment plan or whatever through the app, that might be an opportunity to buy some more of these higher rated ones anyway. I mean, Morningstar's rating is a rating of by how much validity you want to give it. It's there nonetheless. But yeah, as long as you've got a bit of a diversified portfolio, I think you should be all right in the long run. So overall, IOZ, still pretty cheap, 0.09% per annum. Most of these broad-based ETFs are going that way. IOZ had paid out dividends of 5.88% during the period that we're looking at, the last 12 months when we set this portfolio up. ETHI paid out 2.5%. Obviously, you can see there you're looking at quite a significant jump in management fees for ETHI and IEM, which is emerging markets. That paid just over 2% as well. Your management fees a little bit higher at 0.68%. I expect volatility in emerging markets, regardless of what's happening the rest of the market. But emerging markets are counter-cyclical. From as in a broad sense, they're counter-cyclical. So I'd just like to have some counter-cyclical optionality in the portfolio. When you're choosing three, you're just trying to do your best to cover off most of these potential. So IOZ's Australia, ETHI is your international exposure, and IEM, that's your sort of emerging markets, and hopefully outperform over the long term. So push your portfolio along, but it's going to be a bit of ups and downs for IEM, emerging markets. Rightio. Looking at the long-term performance here since inception. This is by no means absolute. It's a little bit rough, but it gives you a bit of an idea. So IOZ since inception, you're looking at 3.5%. ETHI 28.2%. And as we sort of touched on before, emerging markets is going to be pretty up and down. Minus 12.3%. That's definitely dragging us down. So yeah, we've sort of been running sort of doing sort of 3.5 years or whatever now. So look at the overall performance on the next slide. You're hoping sort of in the long term, sort of 5 to 10 years, you can pick it up and this portfolio performs closer to sort of your 9.5–10%. Obviously, this isn't including dividends or anything like that. This is just pure capital appreciation, or in this case, it's capital depreciation. But this is one of the things you have to become comfortable with when we're investing. So, looking at the long term, you're running these type of portfolios. You're looking at 20, 30 years. So you're building these positions. Unless something's critically wrong with something, you wouldn't be changing out too hastily. But yeah, like I say, it's a down year this year. Coming into recession, as I sort of touched on before, is this an opportunity to add a little bit more aggressive to your overall portfolio, with the view to that sort of longer term performance. Yeah, as I sort of touched on in the previous slide, running for 3 years or whatever. So initial investment $600. Sorry, initial investment for the total portfolio was $1,200, I should say. And you can see last year was a pretty good year. This year we've been pretty well brought back to the pack. You're looking at an overall increase in value of just over 5.5% over 3 years, which is pretty low. Obviously, if you divide that 3 years by 5.75, that's a pretty low number. But like I said before, I think you've got to be in these things for the long term. And if you get in and out, if you're tempted to get in and out, it's not really investing isn't especially in the stock market isn't for you. You've got to have the patience, the fortitude, I suppose. We're investing for 20 or 30 years. When we're putting money into ETFs, we're not looking to quickly flip them. We're not traders. We're trying to build our asset base to create a better life for ourselves in the future. So we're just gradually putting away a few dollars and building our capital base. Anyway, thanks for watching through to the end. Hopefully this was informative. Thank you. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's Crack the Sky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are, expand your investment horizon, and crack your financial sky. Thanks, guys. See you later.